Hello, everyone. Welcome back to the Trade Podcast. I'm your host, Richard Moglen, and joining me today is a very special guest, Mark Minervini, the author of Think and Trade Like a Champion and Trade Like a Stock Market Wizard. And obviously, he's a former U.S. investing champion and currently leads this year with a return of 277% in the Money Manager division. Mark, it's a treat to have you on. Thanks so much for being here.
Thanks for having me. And don't forget about Mindset Secrets for Winning, because that's one of the most important books.
100%. And we're going to touch on mindset for sure today. But to start things off, I think we'll focus a little bit on the U.S. Investing Championship this year and kind of how you've traded in 2021. And at the end, we'll go through some charts. You've going to talk about a little bit of what you've traded today and recently, talking about both winners and losers. But to start things off, tell me a little bit about your decision to join the championship this year and the overall experience.
Sure. So, of course, I last time I was in the U.S. Investing Championship was, I think, 24 or 25 years ago, which was 1997, and I won it. And it was a great experience. The reason why I joined it again was I just wanted to show that these techniques that I use are timeless.
Right.
And again, when I first joined it, I had everybody told me, why you shouldn't, don't do it. It's all risk. If you don't win, you're going to look bad. So, I mean, I just figured, I said, if I don't win, I felt like I, certainly could win, but I said, if I don't win, I'm certainly not going to embarrass myself. I'm going to have a good performance. So that's why I joined it this year.
And it's been an interesting year for breakout styles of trading. A lot of kind of choppy markets, a lot of breakouts failing. So how have you kind of adapted your style to basically match the environment? Because it's completely different than 2020, where everything followed through just because the market was so strong. But this year, it's been a little bit of a different environment.
Yeah, well, some people think that I changed my style. I changed my strategy, which is nothing can be further from the truth. The only thing I did was I just assessed what I was getting on the upside, and then decided to trade on a shorter time frame and take less reward, and then just tightened up my stop in relation to that. So I'm always trying to figure out what type of reward I'm getting and if it's paying for my risk. So if my normal, say stop loss is, I average, let's say 5 or 6%, my max stop is say 8 or 10. Well, if I'm not getting the reward, if I'm not getting the gains, then something's got to change. And I can't control the upside, but I can control the downside, and I can control where I sell. So the adjustment that I made was that I just said, I'm going to take quicker profits and I'm going to take smaller losses. And that allowed me to compound very rapidly. And for that style, the market has been fantastic ever since February.
For sure, for sure. And getting a little bit into the mindset, because obviously competing in the U.S. Investing Championship and getting returns publicized, that does have some added pressure. So what are some tips you have for traders to deal with trading, taking losses, all of that? And of course, you've written an entire book on this, The Mindset Secrets for Winning. But yeah, could you talk a little bit about that?
Well, when we talk about mindset, really to boil it down for trading, the main mindset that I have is preparation. So everything that I do is to prepare for every eventuality. So it's all about, planning. And when you first start doing this, of course, you don't have maybe your strategy down. You don't have the expertise. So you study, you read books, you'll go to workshops, you make a plan, and then you trade. And then from there, after you evaluate and you see what happened, what went wrong, what went right, and then you study some more, replan, and do it all over again. So that's sort of the cycle. The main thing is that mindset has to be where you really have to make sure that you're constantly preparing and studying what happened, what went wrong, what went good, and doing that post analysis. And this is something that very few people do, or do for any length of time. Even those that do it, they may do it for a little while, but it's not something that they have in their routine for a long through their trading career. I mean, I've been doing this for this year will be my 38th year trading, and I'm still evaluating and doing post analysis and and keeping in touch with my numbers and making sure that I know the truth about my trading at all times. So that, again, we can get very deep into mindset,
Yeah.
but the main thing is to always, be preparing.
And to dive into that a little bit, I want to talk about both your weekend and daily routine. So, starting with the weekend routine, what do you do to analyze the market, your current stocks, the market leadership, the breadth of the market to make sure you're prepared for the next week and also identify those best opportunities for your particular style?
Yeah, believe it or not, I do very little work on the general market.
Hmm.
I don't really do a whole lot of general market analysis. I mean, I look at the price and volume of the market. I look at the major indexes. I do have some, readings or indicators that I follow, some sentiment, but I'm really doing the majority of my work is 90% of it is all stock work. So
Right.
if there's a lot of stocks, then I'm bullish on the market. If there's not a lot of stocks, I'm bearish on the market, or I'm at least careful. I can't buy anything if I don't have the stocks, if the stocks aren't set up. And if the stocks aren't working, if there are a lot of stock setups and they're not working, then I really know, the market's not a great market. So my routine is really just screening for stocks and
Hmm.
trying to find out, as much as I can about those stocks. And most of them I already know, like there's only so many names. So as I'm screening, if Netflix, Google, Goldman Sachs, for instance, broke out today. Yeah, I know these companies well already. Now there might be some smaller company that I never heard of, so then I try to get up to speed on that and take a look at the fundamentals. And from there, I'm just creating a list. I basically I create three lists. I have my buy alert list. Oh, sorry about that.
No
Probably should
problem.
have shut my phone off. I have my buy alert list. I have my high on deck, and I have my watch list. So basically, watch are stocks that are the candidates, but they're not very close. High on
Right.
deck, they're very close, and buy alert are in position to be bought. Then when that next trading day comes, I've already made the decision as which stocks are ready to be bought, and I've already decided what price I'm buying, and I've already decided my stop loss, and all that's figured out ahead of time. So then when the trading day comes, I just put in my alerts, and when those alerts go off, I start buying stocks and selling stocks.
Perfect. And what are those fundamentals that you particularly care about when it comes to screening or just when you want to look up a stock?
Right. So when you're dealing with growth stocks, there's a handful of ways that I slice and dice fundamentals. However, I'm really only looking at three things. Pretty much, 90% of what I'm doing is focused on earnings, sales, and margins. And that if you get really good at deciphering those three things.
Right.
And like I said, there's a bunch of different ways to slice and dice those. In my first book, Trade Like a Stock Market Wizard, there's a whole section on it's called Fundamentals to Focus On, and it gives you some ways to look at those numbers, breakout years, and acceleration, and various things to look at margins. But those it's really focused on those three fundamentals. That's really when it comes down to a business, it's all about how much, revenues, profit margins, and turning it into earnings. And that's the engine behind a growth stock.
Gotcha. And now moving on to kind of your daily routine, you've got your three lists set up for the week. How many stocks on average would you say are on that buy alert list? Because I found personally it's a lot easier to execute well on a very small select number than try to manage 15, 20 names even in that
Yeah.
morning when the bell rings.
Well, that happens to be, I think, one of the mistakes that some newbies make is where they just want to have everything on the list, and
Right.
they don't narrow it down, and that's just because they don't really have their selection criteria really fine tuned, and they're not looking for the very best of setups. So
Yeah.
I'm really looking for those aces and kings and queens. I'm looking for the premium hands, just like with poker. You want to play premium hands. I want to play premium hands in the market. So I'm looking for the best technical setups. But to answer your question, there could be 40, 50, or 60 names in a really great environment, or there could be no names or just a couple. So
Right.
it's all based on and it's a function of the market environment and whether how healthy the market is at any given point. But generally, it'll be anywhere between just a small handful and as much as 40 or 50 names.
Gotcha. And walk me through kind of from the moment you wake up, your daily routine to prepare yourself for that open, because I know you do a lot of visualization and breathing exercises to help you
Mhm.
kind of stay focused and get you ready to execute at the highest ability that you're capable of.
Yeah, I don't do it every day, but there are a lot of days I will go down to the beach and I'll meditate on the beach if I have the time and if I got a good night's sleep and I wake up early enough. And I like to do something like that first to sort of be in like a nice calmed state in a
Hmm.
natural environment. So that's really great to do to get yourself in balanced, if you will. But I do visualization every single day, and morning and night. I pretty much it's just become an automatic habit that I do. And I also do breathing exercises, which my wife was doing a lot of, I don't, not Wim Hof, but a lot of really sophisticated breathing techniques. She had some friends that they would regularly do it
Hmm.
on a daily basis. And I started learning from them some more sophisticated techniques, but I use a very basic box breathing technique that Navy SEALs use when they're under pressure. And so I do that in the morning. I do my breathing. It's only 5 minutes of breathing, and then I do a mental rehearsal.
Hmm.
Especially I'll flip on the TV real quick and just check and see if the Dow's down 800 points, or if it's up big. And then from there, that'll sort of like let me know what I need to prepare for. If all of a sudden the market's down huge, I know that I'm going to be going into gaps down and probably some stops being hit. So I start to think, to play through my mind how I'm going to handle that. And just the opposite, if things are, moving up, and the market's up huge, I might have some gaps that you have, the last few days have been a good example. And even today, where some stocks, or yesterday was a good example, where some stocks that were on my list actually gapped out. There were small gaps, but I don't chase gaps. So
Hmm.
I want to make sure that I'm disciplined. And if the stock doesn't meet my criteria, if it gets away from my buy point, I'm going to leave it alone. So I start going through that and visualizing, what could happen. And
Right.
and I already know the names on my list. I already know what I'm interested in. So as those stocks are moving, I'm prepared. Again, it's all about preparation. So this is another part of the preparation that not only am I doing all the work, but I'm also doing the mental preparation to then intersect with that work.
Perfect. And getting a little bit back to your trading style, obviously you're up 277% this year. That's kind of unthinkable for many people. What are some keys to achieving returns, triple digit returns and greater, that you think most people have misunderstandings about, or you think would help out new traders?
Well, you're definitely not going to get those big returns by having a well diversified portfolio and low turnover and all the things that you might be told from a financial advisor. So
Yeah.
this isn't something, they don't try this at home, kids, that kind of thing. So I'm using leverage and I'm taking at times very, very large positions.
Hmm.
Um, but I'm still managing the risk, it just as stringent as I would otherwise. But I am really gassing it quite a bit this year to get that. And there's tremendous amounts of turnover. So you need turnover, you need concentration, you need concentrated positions, you need timing too, because you can't you're going to have to avoid dead time.
Right.
You have 1 year to lay down this return, and you're going against a whole bunch of people where some people may just get lucky. They stick it in one name and take a big position, and so you're going against not only skilled traders, but you're going against a large group where
Yeah.
someone along the line is going to get lucky. So there's going to be usually going to be some big returns. So you've got to get a pretty big return to, going back, you look at these contests. The good thing is this is a real money contest. And in my division, it's $1 million. So you're not going to
Yeah.
somebody's not going to go, a professional's not going to go and stick $1 million in a penny stock probably to win
Yeah.
the U.S. investing championship when there's not even a cash prize. So that's the good part about a real money contest. And the only contest that I would ever go in would be a real money contest. The $20,000 division, yeah, people might get a little crazier there.
Yeah.
If I was in the $20,000 division, I certainly would be taking even more risks, because that would be an amount of money that if I had trouble with, that I could recover from. So I don't even remember your original question, but but yeah, what I've been doing, with the U.S. Investing Championship is just is very aggressive. Probably the second most aggressive that I've ever traded. Going
Hmm.
back, probably the most aggressive I've ever traded was probably in 1995, where I was up over 400%. And then for the 97 US Investing Championship, I was pretty pretty darn aggressive then too. And that year I was up 155%.
Right. And I always find it interesting. How do you personally define risk? And also, what kind of total open risk on your portfolio have you been taking on this year?
Well, open risk. I'm not sure what you mean by open risk. I mean, are you talking about,
If everything got stopped down your portfolio,
yeah,
that type of thing.
everything
Yeah.
went against me at one
Yeah.
time?
Yeah.
Yeah. Okay. So total risk. Well, that would be, I would say that the risk would be high when if I go into these leverage positions, I start buying on leverage, but I'm watching these things all day. So if they started to
Right.
move against me, I would be paring back pretty quickly. If I'm on leverage and I'm, have these huge positions, I'm not taking any big risk as far as letting them stop me out like I normally would on a normal size position. I might have a
Right.
4, 5, 6, 8% stop on a regular sized position. But if I'm in and I'm 4x leverage in a stock, if that thing doesn't go intraday and get me at a gain right away, I'm out.
Right.
So to answer your question though, a full, drawdown, it's the same thing as it's the same as individual positions. So if my max stop on an individual stock is 8%, well, then my max drawdown would be 8%
Right.
from principal. Now, from a peak, now that could change, because now if you were up, say 30%, and you said, well, I'm going to put, I'm going to backstop, up 10. Well, now you've got you've given up 20%. Or if you go all the way back to break even, you'd give all that back. I don't allow stocks to go down like that. I mean,
Yeah.
once I'm up, I'm nailing that profit down. I'm very good at maintaining my profits and protecting them. Because of that, there's a trade-off though. Because of that, I very seldom hold for a big move,
Right.
because now I'm going to get clipped out on a pullback. So that's you can't have your cake and eat it too. If you're going to short-term trade, you're going to give up the bigger move. If you're going to go for the bigger move, well, then you're going to give up the short-term. You're going to give up some short-term gains because you got to go through pullbacks. So one, you have to sacrifice.
Yeah.
So in my experience, going for the shorter moves, you have more control over, and then you can roll that over and get the compounding.
And this year, do you have a sense of what your average gain is, your average loss, and also your batting average?
Well, I guess not exactly. I mean, my batting average is always about the same. It ranges anywhere between 35% and 65%. When things are
Hmm.
going really good, it's above 50. When they're going bad, it's below. I mean, to tell you the truth, like, my assistant Bob asked me, he's like, what are you up, for the year now? And I'm like, I have no idea. I'm basically just sort of, they say kicking ass and taking names. Half the time a lot of people would never believe this, but a lot of time I don't even know what the market did. I don't even know
Yeah.
what the Dow did at the end of the day. I got to look and see. I'm just trading. I'm trading the setups. I'm totally in process. I do the post analysis afterwards.
Yeah.
But again, also I think, the number is going to be definitely skewed because, all right, for instance, I take this big giant position, and if that stock doesn't go up right away, I'm out. So it's this little
Hmm.
tiny loss, or maybe even a little tiny gain. But then, I'm holding a regular size position for a bigger move. And that might be, that profit might be 10, 12, whatever, 15%, 17%. And the losses will be bigger. But there's so much jockeying for position, and there's so much trading, that it's definitely compressed everything, way down. But exact number, I don't have an exact number right this second.
Gotcha.
Yeah.
And talking about this very aggressive style of trading, are you doing reverse pyramiding, meaning maybe you go in with 40% of your total portfolio size, and then as soon as it starts working for you, you're kind of taking some off as it works, or are you kind of building a position into a breakout or that type of thing?
So how I trade is I normally start small, and then I build up, and then I go back small as the stock becomes profitable. So if that's what you call reverse pyramiding, I always use progressive exposure. I never just dive into the market until I get some traction.
Right.
I'm putting in test positions. As
Right.
soon as those test positions start working, I ramp up really fast. And this is the difference between a pro and an amateur. An amateur is going to probably need a lot more evidence. And by the time they get the green lights. It might be a little late. And that's why progressive exposure, a lot of people say, oh, well, I tried it. By the time I ramp up, then everything pulls back and then I pull back. Well, that's because you're not moving fast enough. You're not
Hmm.
seeing what you need to see and reacting quickly. I've been doing this so long that I know, when I see the whites of the eyes, I know when to shoot. So I move up very quickly. Now, as I start, these stocks start going up, then I start scaling out into
Hmm.
the strength. And that's a big part of not having drawdowns, is selling into the strength, because what you're doing is you're always at equity peak.
Yeah.
So the stock may keep going higher, but you sold at the highest price. So even if it comes down, you're out, right? So there's no downside. There's no downside give back, and there's no upside maybe either. But you're at that point. You're at equity peak. So if you sell into strength, you're always selling at the highest price. So there is no drawdown. It cuts off the volatility. Now the other thing too, I might add, and this is really important. I'm
Hmm.
always angling, and because big performance is one thing, but what I'm really, really I think good at and what I'm proud of is the fact of the low drawdowns. And because most people who get the big performance have the volatility too. So what I do is at all times, I'm always thinking and trying, my aim is always to improve my worst case scenario. That sentence literally is a multi-million-dollar sentence. If you just think about that, always improve your worst case scenario. So let me give you an example. So I buy a stock, it
Hmm.
starts moving up. Okay, so now the first thing I want to do is I want to protect my break-even point. I want to finance my risk. So as that stock moves up, I can move my stop to break even. Now I just improved my worst case scenario. Prior to that, I had a stop, let's say at 5%. So my worst case scenario was a 5% drawdown, right?
Hmm.
So now I've improved my worst case scenario, but I can even make it even better. Let's say the stock goes up 8%. I have an 8% stop. I sell half of it. I can now allow that stock to come all the way down and hit my original stop and give it the room that I wanted to give it originally, but break even. So I've
Hmm.
improved my worst case scenario, and I've given myself a chance also to participate in a bigger move, of course, with only half the gain, or I can move my stop to break even, sell half. Let's just say it's up, 16%. I sell
Hmm.
half, and now if it stops me out at break even, I guarantee myself an 8% profit. So always looking to improve my worst case scenario. And by going in with that mindset, you start achieving a lot less volatility, because your goal is not the upside. Your goal is to limit the downside.
Right, right. And this year, are you even quicker to move your stop to break even to make sure you're limiting those drawdowns as much as possible?
Yeah, well, it would certainly, again, with the big positions, I'm sometimes going in with a microscopic stop and trying to get the timing absolutely perfect. If that
Right.
stock doesn't move right on cue, I'll have a time stop, or I might have a very, very tight stop. Not even the low of the day. It might just be, a lot of times I just go in and I just say, I only want to risk X amount on this.
Yeah.
Okay, whether it's, you can call it $1,000, $10,000, whatever the number is.
Hmm.
I've already determined this is the amount that I'm willing to risk on this, and then that's where the stop is.
And I wanted to ask you this about in terms of stock selection this year. Are you more focused on kind of the lower float names, which are going to be a little bit more volatile, but can make those really quick moves, or are you sticking with kind of the larger float, more institutional quality type stocks?
I trade whatever sets up.
Hmm.
So, and I trade accordingly. So if a very thin stock sets up, I may trade it, but I'm not going to have a big position in it. So I'm not going to be able to, just because of liquidity. So I'm trading whatever sets up, whatever meets the criteria. That's what I'm going to trade. See that with that with that methodology, you allow the market to tell you where to put your money. So if, let's just say I was to say I'm only going to trade mega caps, and then all
Hmm.
of a sudden there's this big bull market in small caps, well, I'd miss it, right?
Right.
So my way, letting the market tell me where to go, I'm going to be where the action is regardless, because I'm not having any predetermined bias, and I'm not prejudiced for any. And again, if it's really thin, then I can't trade a big size in it. I'm just going to have, sometimes, there's a really thin stock. It trades 40,000 shares a day. I buy 1,000 shares. That's that would be a very, very tiny, insignificant position for me. And then you get something like, a Goldman Sachs, and, I'll buy $8 or $10 million in it.
Hmm. Hmm. Perfect. And so you said you actually brought some charts that you wanted to go over. Feel free to share your screen, and I'd love to just talk through what you were looking for, what was the pivot that you chose, and how you execute the position.
Sure, we can go over some charts. Schwab. So this is a recent purchase. You can see
Hmm.
it's a really good large base here, tightened up nice on the right side here. So I was looking at it right here on 10/11, but it only
Hmm.
had just a couple days. I was hoping it tightened up a bit more. It looked like I might have missed it. Intraday, it started breaking out. I was like, okay, missed this one. It's probably just going to go. But nope, it came back in, it squatted, then it had a little shakeout day, and then it came back. And you can, some of these things you can read about in my book. Some of this vernacular is mine. You're not going to hear it anywhere else. But reversal recoveries, squats, all these different things. So this had a 1, 2. This is a 1, 2, 3, a fourth day reversal recovery. And very often I'll buy a stock that's in a pivot if it also takes out a squat high, which I call a reversal recovery. And that was where we entered this stock right here. And this, again, this is made, 1, 2, 3, 4, 6 or 7 days. Most of these stocks that have been breaking out lately, I mean, you get some that have worked, but it's like I've been calling them the pop and drop theme. They'll go up 1, 3, maybe if you're lucky, 5 to 7 days, and then that's it. Then they come all the way back down and they reverse and they take all the gain away. So this has been just trading overweight positions intraday, and then smaller positions for the swing move. Let's see what else.
Could I actually ask you about this one, Mark?
Sure.
So here we've got a gap up as it's making its way through that squat reversal pivot. Can you talk about where you specifically entered on that day and when, and what you were looking for on that day before you executed?
I can't remember exactly, but I'm pretty sure this was bought immediately as it started moving up in the morning. So on the gap, but you see the gap is so microscopic. It's not, if you were to measure the gap, it's not even above the high. So it's not like it's extended. You wouldn't say that this is, 2 or 3 or 4% above the pivot. It actually is right at the pivot. So I can't remember if I bought it right on the gap, or I think I bought it as it went through the 78.94. I have to look. Let me see if I actually have. Okay, so 79.45 was the buy price.
Mm-hmm.
So it is, as it went through this level, 79.45. So I got about, it looks like maybe a 45 cents of slippage.
Gotcha. And as you're looking to execute and watching this, what time are you only looking at the daily time frame, or do you also kind of nail down on lower time frames just to see how it's acting intraday?
No, I do have a 5-minute up on I have a separate screen that has where I enter my orders, and it has a daily, weekly, and 5-minute. So I'm aware of the 5-minute, but I do not trade off of intraday charts at all. Even if I'm doing a day trade, it's off of the daily chart, and I always look at a weekly too.
Gotcha.
Yeah.
And for this one, I don't know if you remember, but if you're buying pretty much right at the open, where's your initial stop loss on that? Or are you just watching it intraday, and if it reverses, because sometimes these gap ups can just completely fade. So I want to know kind of how you're managing risk with this buy.
Well, if you're trading this from a swing trade, I have a different stop on day 1 than I might have on day 2 and on. So for instance, on the very first day when this comes out here, just think about it. If this stock looked like this, okay, it breaks out, and then I don't know, end of the day, midday, it comes off and it looks like this,
Yeah.
and it closes below. I'm sorry.
No
It
problem.
takes out this low. So now you would have an engulfing, right? And this is what I refer to as the megaphone effect. When you break out, now you've got this, right? So the volatility has widened, right? So that would be almost an automatic sell. I'd probably just reverse my position from a swing trading basis, even from a day trading basis. Now, if your upside is much less than your swing trades, you're probably going to have to use maybe the day's low or previous day's low or whatever, maybe just a mathematical stop. But from a swing trading basis, now if you measure that from here, well, what did I say? 49 cents, right? 79.45. We'll get it pretty close there. Down here, that's about 6%, 5.5 to 6%. So that's about normal. That should be, see, that should be enough room. That should be enough room. You know, if you got to have to give a stock more than 5 to 8%, well, then your timing of the trade is not very precise, and you're not coming from these, you know, these tight DCP entry points. So again, I'm using the stop. The risk is actually a selection tool. Now, I'm not going to go into a stock that's all over the place, because then, you know, it could just be acting normal, but it's going to knock me out because it's a bucking bronco. So I'm not riding those bucking broncos.
Right.
Want to see a couple more?
Yeah, go for it.
So PayPal is another one. So this is right here. Bought it right here. And so you can see again, this tried to break out and then it squatted. But then the next day, it just undercut the low, ended up closing up. So this is where we sold it, right here, here, and then sold some here. Yeah. And then recently, we actually bought this back over here. It's not drawn in, but I think it was right here. I think it was on the 7th.
And there's the bearish engulfing. Yeah.
Yeah, and there's the bearish engulfing. See right there, boom. That's not a very good sign right there. And if I'm going to hold, you know, I'm certainly, if it starts falling down from there, you know, I'm going to definitely get out. So that's not a good sign there. So another one, and I remember, if you remember, I was talking about the steel stocks on Twitter. I really thought these were going to have a much bigger run, but they didn't. They just had a short spurt here, but bought it right here. Coming out of this little pivot right here. And it was nice because it ran up real fast. You got 1, 2, 3, 4. You see 1, 2, 3, 4, 5 days. Just like I said, you're getting that 1, 2, 3 days, sometimes 4, 5, 6, 7 days of pop. And then what would normally happen in a really good market, if this was coming off of a bear market, you know, correction, you know, and these were the first stocks to be breaking out, you know, you'd want to hold to this first pullback, and you maybe even, you know, several pullbacks and play this for a bigger move. In this market, you know, you want to sell right into this, and you see it has a little reaction here, but then it just fades, and they can't hold. So these are the winners too. These are some, you know, some winning stocks. Here's PAG. So was actually buying it right here. And this wasn't enough to stop me out here. So, and then it reset, and this really got really nice right here and just took right off. So this is another stock that's set up really. If you take a look at the base here, this is really, you know, picture perfect.
That's textbook right there. Yeah.
Yeah, it's really textbook. Really just big cup with handle. I mean, perfect setup here. Still holding up pretty good here. Another one was SKY.
Did you add more on that second reset there?
No, I did not. But it's certainly you could have. I think on the platform we advised that we said if you bought a smaller position, you should add to it here. If you hadn't bought a position, you should initiate here. I'll go back to that just so you know what we're talking about. Yeah. So again, what people have to understand is that at this point right here, that's all I saw. You know, so this looked good enough to buy. It did look a little bit short. It would have been nice if it was a little bit longer on the right side, but it looked fine. But then as it goes through here, now it got even better. Now you really have a fully, you know, developed right side. So again, if you had not bought it here, or maybe you had a tight stop and you got knocked out on this little pullback, right? You got 1, 2, 3, you got 4 lower lows, and which is a violation in my book. But again, I always look to the 3rd and 4th lower low and see if there's support. You got support on the 4th lower low, and it turned right back up. So if it doesn't hit my stop, that's not enough violation to stop out. So now over here, you can add to the position, or you can even initiate a initial position if you haven't bought it yet. Sorry about that.
And no worries. And Mark, can I ask a question?
Yep, sure.
So do you have kind of a mental checklist that you go through before you execute a position? For instance, do you wait for volume to come in? What are you looking for right before you go ahead and put in the buy order?
No, because you see the volume, I'm going to look and see if the stock, a lot of times I'm watching it very carefully, and as it starts to go, that's where I start hopping on it. So I'm waiting to see if the stock starts to go. So that would be sort of the watch intraday, you know, watching it. And I'm aware, I see it as it starts to move. I'll set an alert. An alert will go off, and then I can't, you know, if it's 9:45 in the morning, you're not going to have the volume. The chances that you're going to have big volume at 9:45 in the morning or 10 o'clock in the morning, but you could extrapolate the volume and see how it's running. So you're at 10:30 and you've already got let's say 1/3 of the daily volume, that's a good run rate.
Right.
So I'm looking at the price. I'm just looking at the price. When the price gets through the level, and then I'm watching very carefully the subsequent action, seeing how if it holds up. A perfect example was today. I'll show you a stock today. Bought CFLT today. So this stock first came out, and then it did what I call an early day reversal. So it started coming out, and then it squatted, but it was still early in the day. I mean, we can have you look at this is a 5-minute here. Right? Let's see here. So you see here, it comes out in the morning, and then it pulls back right away, and then it just goes through. It sits all day, but we ended up having a strong close here. So that's good. That's good. So that's fine. That's acting perfectly fine. So I'm watching it to see how it acts intraday, that breakout day. Now we look down and we see, okay, the volume was a little bit above average. Okay, that's good. You had a good close. Now these subsequent days, and this is something, if you go to my book, Think and Trade Like a Champion, I show the exact things to look for, or that I look for, what you want to look for, what I call confirmations or violations. Is the stock telling you, hey, this is the train's coming in on schedule, this is acting normal, sit with it and hold it for a bigger move because everything's going as scheduled, or this is concerning, or starting to see abnormal action. And that's what you want to look at, those first 3, 5, 7, 10 days, and ascertain whether the stock is acting right from day one into the first week or two. And that's going to let you know whether the stock, whether you should be holding it, adding to it, reducing it, and so forth.
And talking about that right side, how tight, basically in general percentages, do you want that right side, that pivot to form at? I think when you spoke earlier at Dr. Rish's class, you mentioned 10% is kind of your guideline, but what do you kind of use?
I'd like it to be single digits. I would like it to be in the single digits. Now the thing is, especially like on something like this, I have a friend that does some really good fundamental work and likes this company, and so it's set up technically, and so I cut this a little bit of slack here. I would have liked this to tighten up, but I know we're late stage right now. I know there's tons of retail eyes on all these stocks. If there's any kind of base, every Tom, Dick, and Harry is jumping on these stocks, and that's why they're coming out early. They're running up. A lot of them run up and fail because there's just not enough volume in there. It's retail volume. Institutions come in, then they sell right into it. So I'll try these, and if this doesn't work, I'm real tight on this. If this doesn't work and I don't get a good breakout and I don't get the follow through, well, then I'm just going to cut out. I'm going to get out of it. So you just got to be a little more vigilant. Again, I've been doing this for almost 4 decades, probably longer than most people watching this are alive, or certainly as long as they've been trading. So I've got a really good feel and a really, really good sensors, for when things are acting normal or not. But yeah, so you want to see a few that did not work out, or that had some violations? Show you a few. So Burlington, this came out of a perfect base, just real tight right here. You see, you got real tight. The volume came right in, so that's really great. That's setting up just right. Broke out. You had a nice breakout on that day. Look, the volume is well above average. Next day, you start to follow through, but then you reverse. So all this is okay. It's still acting fine. Even the pullback here is okay. But as you start counting the days now you get into day 5, 6, 7, right? So remember I said, watch the first, 3, 4, 5, 6 days up to the first 2 weeks. So we count the days. We got 2 up days, 3, 4, 5, 6, only 2 out of 6 up days, right? You've got 1, 2, 3, 4 lower lows. And on that 4th lower low, it's a bad close. Volume is starting to come up. So now you got some violations. So this, if you have not hit your stop yet, this should definitely get your attention and say, wait a minute, this is not acting right. Now you try to rally back, and this will very often happen where you'll get that rally back and everything's okay, and then bang, then it comes in and you get that gap down. Maybe you go into earnings, or there's some surprise that comes out. So again, this is not acting right, and so you'd be reducing here, reducing or maybe even stopping out. So this is one, and then you see here, it's off, pretty substantially from that point. Another one is, let's see, ATVI, Activision, of course. So this one here, well, let me just make sure I get the right date here. 6/14, right? So that's right here. Yeah.
Yep.
So bought this coming out right here. And again, let's look at this base. So this is coming out. And again, if you take a look here, you draw a line right across here, it was really clearing most of the supply here. So that looks pretty good. You'd only had a short period of time that it traded above this level. You're pretty tight on the right side. Volume came down. So again, you could get it right. I mean, you could, and it just doesn't mean that it's going to work. That's why you have to embrace you got to embrace stops, because half of these plays are not going to work. This is about probabilities, but right away. And what I want it to stop me out immediately. Like if it's going to stop me out, I want to know day one, day two, because then I can redeploy the money and move it into something else that's moving, or go into cash and protect myself if this is the start of a correction and it's starting to be picked up in my names. So I want to know right away, because I want to avoid dead wood. I want to avoid, sitting, sometimes someone will get upset, oh, you got stopped out. They get stopped out right away. Well, would you rather have it go, stop you out 3 months later and you get the same loss, but then you lost 3 months of time? The time is very valuable. Time is money. You want to get compounding, to maximize compounding, you need to compress the time. So I want to know right away. This one, let me know right away. Breaks out next day, bang, right in. This has a couple violations. So see, it comes out here on volume. The next day, you've got a sell-off and the volume's larger.
Higher, yeah.
And then it goes larger the next day too. So that's what I call low volume out, high volume in. So the violations we have here are low volume out, high volume in, close below the 20, close below the 50. Sorry, 1, 2, 3. You got 4 lower lows. So if this hadn't already hit your stop, you should be gone, because there's just too many violations. This is completely abnormal. And then again, you see it tries to rally and then rolls over, because this is under distribution. And that came off quite a bit here. Let's see what else. So ZLAB.
Yep.
ZLab. This was setting up. I actually tried to buy this coming up from this pullback buy right here. So I tried to get a little head start on it. And right away, it didn't act right. And again, you see, right after you get the violations, you get the 4 or 5 lower lows. It closes on its low. You get no follow through. So this is just not acting right. And then it comes back. Like, oh, everything's okay. But see, then the real trouble starts happening. So that abnormal action was giving you that tip off. And then of course that sold off quite a bit. And then of course, what everybody knows, some people got very surprised with this, was Snap. This one here, we were originally buying Snap way back here. This is where I was first buying Snap. And I sold it way too early. I sold it into here, which I believe was the earnings gap. Tried it a few more times. Over here, we actually got back into it, but we got stopped out right on this day right here, which was on 10/18, this outside day. And then a few more days, and then bingo, the big surprise that KO'd a lot of people on this stock. So that was one that we recently stopped out of. So, those are a few examples of stocks that worked and stocks that did not work. And like I said, the key is to pick those warning signs up, and to keep that loss to a minimum. But the main thing is, I know everybody wants to know, they'll say, well, what's your average loss? What's your batting average? What's important is what your average gain is. That's what's important. The number that you're searching for is your personal average gain, because let's just say it's 6%. Well, then and your batting averages will just say 50%. Well, then you automatically know, to be at a 2-to-1, you have to average 3% stops, right? It's a mathematical equation. Once you know that information and you know what your average gain is, you know how many times you're right versus you're losing, your batting average, percentage of winning trades, the loss side, the slider that you have control over. See, these other, think of them as different sliders. Some of them are automated. They're moving on their own. Right. So, but you have control of these few moving parts: what you buy, when you buy, how much you buy, and when you sell. Those are the 4 things that you have complete 100% control over. You don't control how much the stock goes up. You don't control, anything other than those 4 things. So you can't rely upon that. All right. Your reliance has to be on the things that you control. Now, it's all about making assumptions. So what is your assumption based on? I mean, it's just pie in the sky. You just think the stock can go up X amount. That's not what I do. I look at my real results. What am I performing? How am I performing on the upside? And then I choose that stop based on a fraction of that result on the upside.
Gotcha.
If that makes sense.
No, absolutely. And I also wanted to touch on progressive exposure a little bit, Mark, because that's such an important concept. And I think reading your books really cemented that for me, the importance of it. So I don't know if you want to bring up a chart of just a general index and talk about how you've handled increasing exposure back after this recent market correction or pullback.
I can certainly do that. I know, again, though, I would caution anybody to try to correlate and start looking at the indexes and make your trading be based on the indexes. It's just the opposite. I'm going to be basing my trading
stocks
on
first.
The stocks. Now, they might or might not correlate with good timing on the indexes. There's times where you'll get like, all right, look at this correction in the NASDAQ. Okay, so you come up this right side. You might think, oh, well, coming off these lows here, maybe this is where all the stocks started breaking out of bases. Maybe not. They might have just started today. I've seen times like 1995 was one of my biggest years. I was up over 400% that year. The market had already gone up for an extended period of time, and I didn't even start trading until April of 95. So, and we could probably go back and look at that. I could probably pull this chart back, but the market was already up. It was already up. And I didn't start getting the stock setups until the market looked like it was, had already made a pretty good move. So again, sometimes you're in before the market even makes a low. So the market's correcting. You're in a bear market. You have a thrust down, another thrust down. On your second thrust down, or your rally off the second thrust down off the lows, a bunch of stocks start breaking out of bases. You start buying some stocks. Now the market takes another downturn, makes a new low. The news is horrible. We just hit new lows. The Dow's down 500. Meanwhile, the stocks that you bought that broke out are just pulling back to the breakout, perfectly natural. Right. You're in the leaders. That happened in 1990 going to 91. I bought a whole bunch of names, US Surgical, Amgen. These stocks were breaking out in around the lows around October. The market didn't really start taking off until January 15th, after it built this big giant cup with handle. We went to war in Iraq, and then bang, the market took off like a rocket. But the leaders were already coming out of bases months ahead of time. So again, focus on the stocks. I always say this: imagine if nobody ever invented an index. There's no such thing as an index. Could we still trade? Of course we could. We probably would trade much better. What would you focus on? You'd focus on individual stocks, right? You would follow individual stocks. And maybe you would create an index in your mind. You'd look at a whole bunch of, the semiconductor stocks are acting great. So that would be the same thing as having an index of them, but you're just doing it anecdotally by looking at the individual stocks. So, but now we've created all these indexes. So now all of a sudden, a basket of 30 stocks is called the market. How ridiculous is that? There's 10,000 stocks in the market, and we're going to call a basket of 30 stocks that are price weighted. They're price weighted. So only a small handful of them even account for most of the move on any one day. And there's only 30 of them. And suddenly that represents the 10,000 stocks. It's completely backwards. The 10,000 stocks are what's important. How is the broad market acting? And if there's a big, if you're going and looking at the waves coming in, and you're looking at one individual wave, well, the current, the current of the ocean, the direction of the ocean, whether if the tide's coming in or going out, and you're trying to look at these little waves coming in, but the whole tide's going out. Well, which is more important, right? The tide.
Right. Makes sense. But I just kind of wanted to hear generally how you increase exposure from this correction. How quickly?
I know. He's like, that's great, but I'd like you to answer the question.
No worries.
I do that all the time. You know that.
No. You made an excellent point.
I'm a ranter.
No, for sure.
Yeah. So you want to know how I increased the exposure?
Yeah.
Okay. So again, that has nothing to do with the indexes. That's where
Right.
you threw me off a little bit.
Yeah,
You're like,
my
let's
fault.
bring
My
up
fault
an.
on that.
I think what you're trying to say is look and correlate it, correlate it.
Exactly.
Yes. Okay. So, and again, like I said, it may correlate, it may not.
Right.
It may correlate where I'm getting real aggressive off, coming off the lows, or it might be late. So
Hmm.
how I do it is I'm just looking for stock setups. If I
Hmm.
start seeing stocks setting up and they're meeting my criteria, I'm going to take a few small positions, some pilot buys. Normally that's going to be, if my normal size is, let's say 20, 25%, it'll be 5 or 10%. If
Hmm.
those work, maybe I take 2 trades. If they work, I'll bump up to 15, 20%, or maybe I'll just bump up a few more positions and I'll go up to 25, 30, percent invested. Normally my first 2 entries in the market are anywhere between 25 and 50% invested. And then
Hmm.
if things are working, bang, I move real quick to 75 to 100. And again, it's just based on the individual stocks. And I know people always ask for a number. They're like, well, how many trades? How many have to be up? How much do they have to be up? Do they have to be closed profits or open profits? It depends. It depends. If I've got some open profits, let's just say, I bought 3 or 4 names and they're all up 6, 8%, and that's looking great. And I
Hmm.
see my buy list is just expanding. There's a whole bunch of names setting up and stocks breaking out. Well, that's really good. Like I'll increase my exposure from there. But let's say just the opposite. Okay, I got those same 4 stocks. They're up, but there's not many stocks on the buy list, and a lot of stocks are breaking out and they're failing. And I have got a couple names that are holding up, but I'm really just not seeing what I need to see for those follow-up names in that second
Right.
wave or so. So that will be where I might wait a little longer and I might pause a bit. So there's just not really a set mechanical black box number. There is some feel in there.
Gotcha. Perfect, Mark. So to wrap things up, I thought I'd just kind of ask you one last question. What kind of general advice would you have for people, or suggestions for what to study for traders who want to kind of match your returns and get to that level of super performance?
Um, so well, to match my returns, that's like I think that's like saying, I mean, I don't want to sound arrogant, but that's like saying, what do you have to do to start off playing basketball and play like a professional NBA player? Even it's going to take time. All right, it's going to
Approach
take.
that level. Yeah. Yeah.
Yeah, you're not going to and I think this is one of the problems that people expect. They open up a stock account and they expect to be doing great, in a couple months. I mean, there's no business that you would ever think that you would ever have that expectation. Like you wouldn't go to college for 3 months or even a year and think that you could be a trial attorney, or think that you could be a surgeon, or you wouldn't even go, if you went to McDonald's, you wouldn't even know how to operate the fry later or know how to manage a McDonald's. It would take you months and months of training and probably years to work your way up to be an assistant manager.
Right.
So stock trading is a lot harder than those professions. So, you got to put in the time. You have to put in the time. Now, I don't want to say you shouldn't have expectations of being great and having huge returns and winning the U.S. investing championship and being being a smashing success. Everybody has that potential, because
Hmm.
you're not born a great stock trader. You
Right.
learn this. However, to get to that, you need to temper your expectations, because if you're expecting this soon, you're going to get disappointed and you're
Right.
going to quit, because you're just putting way too much pressure on yourself. So it's going to take time. Study. The main thing is to find a strategy that has an edge, that has been proven, that that fits your personality and that you can believe in and commit to it. And the key is, Zig Ziglar said, the best sale that a salesman can make is to sell themselves. That
Yeah.
before you can sell somebody else really well, you've got to believe in the product. So you've got to believe in what you're doing 100%, and really, really sell yourself on it and do the work and know everything about it, be a specialist. Then you can be really great at it. You're not going to, I mean, just like sports, you're not going to be able to be a great hockey player, basketball player, football player. You've got to put all your effort into one thing, become a specialist. And even when you get into that, you specialize in one area. You might be a center or a guard, or a quarterback, or a running back. again, it's all about specialization. The people that are great champions, they do one thing well. I mean, you got a few people, Bo Jackson and Deion Sanders, they were able to play baseball and football both well. But how many people are even able to do two sports?
Right.
Let alone. So the trading is the same. You got to really, really concentrate and get good at one thing, commit to it, and think in terms of 5 to 10 years, not 5 to 10 months or a couple of years. Make a 10-year plan. Just imagine if you're 30 years old, 40 years old, if you could get this down in 5 or 10 years and change your life, that's a great goal.
100%. Well said. And Mark, I'll have a link to your Twitter down below. But what other resources and where else can people learn from you and learn your style? I know you've got the Master Trader program coming up very shortly.
Yeah, well, it's coming up next week, so there's only a short period of time to register for that. But that's where we go over this stuff, in depth from A to Z. You came to the Master Trader program, right?
Yeah, last year.
Yeah, so it's it's a giant undertaking to go through the Master Trader program. It's this year it's going to be a total of 7 days. So, and I don't know, 30 hours of curriculum plus a live trading day. So that's something that you can find at forstocktraders.com, or you can go to minervini.com and learn about it.
And for everybody watching who's interested, I would also highly recommend reading Mark's books multiple times before you attend, just so you really are coming prepared. So with that, Mark, I wanted to thank you so much for coming on, walking through the charts, talking over your style and process. We really appreciate you coming on, and yeah, thanks so much.
Okay, well, I hope it's been helpful.
Oh, for sure. And to everybody watching, I hope you enjoyed as well. Leave a like down below and subscribe to the Traderline channel, and we'll see you guys in future videos. Thanks.